Well, markets appear to be in a bit of a holding pattern as investors wait for news from Washington on taxes and, of course, healthcare. So is now a good time for investors to rebalance their portfolio? Let's ask Rob Morgan. He's Chief Investment Officer at Sethi. Good morning, Rob.
Hey, good morning, Leah.
So, Rob, what sectors do you like right now?
Well, my favorite sectors, Leah, really are financials, technology, and consumer staples. Financials really should do well because as rates rise and the yield curve steepens, that's going to help their profits. Technology just seems to be, regardless of what the president does with his policies, on a good track right now. Consumer staples a little bit more defensive, and I'd say, you know, after the president's health care bill fell through on Friday, I think having at least some defensive exposure makes some sense.
What's your take on energy, Rob? It was a great performer last year, up 23%. It's down this year by 7%. What's your take on the rest of the year? I know OPEC's going to extend their production cuts and the like. What do you think?
Yeah, Lauren, I'm underweight the energy space right now for a number of reasons. I mean, there doesn't seem to be a lot of visible earnings growth in the space. Also, too, commodities in general, if some of the shine comes off of Trump policies, commodities in general, including the energy space, will probably suffer.
So let's talk about some of your market ideas right now. You say that you should overweight small cap stocks versus large cap stocks. So do you think that small cap stocks have more room to run?
Well, I think, Leah, there's a theme here is the dollar is going to continue to rise, and when that happens, that really hurts the big cap U.S. multinationals. It hurts their earnings, and so conversely, that favors small cap stocks. And yeah, I would say they certainly have some room to run here. Absolutely.
An hour before the opening bell today, we get the final look at GDP for the fourth quarter. I know this was during President Obama's time for the most part. We're expecting 2% growth. How do you get this economy to grow at a 3% and 4% sustained pace? I know. There's no answer to that question.
That's the $64,000 question right there. Right. Well, hopefully, there's still optimism that deregulation and tax reform is going to help provide a foundation for that to happen. Now, is 4% may be unrealistic, but yeah, we need to start getting closer to 3%. That's for sure. And hopefully, as I said, policy changes will move us in that direction.
And Rob, the so-called FANG stocks, Facebook, Amazon, Netflix, and Google, parent company Alphabet, those all hit record highs in March, and they're up sharply year to date. You mentioned that you like these stocks. Do you expect them to continue to perform?
Well, Leah, I mean, they are those in particular. There's some of them are starting to reach nosebleed heights as far as their PE ratios go. I think certainly owning them in a diversified portfolio would make some sense. But in general, I feel pretty positive about the technology space.
Yep, you like tech, financials, and staples. Rob, why do I keep feeling that this is a market that only wants to go up?
Well, you know, we're up 5% already this year, Lauren, and I projected we'd be up only 10%. So I think we're gonna see kind of a sideways market here before too long for a while.
We'll see how those administrative policies come into play. So thank you, Rob Morgan, Chief Investment Officer at Sethi. Nice to see you, and we'll see you soon.
Thanks, Leah.